statement training webinar series. That's not the exact title, but it's basically what we're doing. We focused on the balance sheet last week, and this week we're going to focus on the income statement. And in both sessions, Zane did and will continue to make connections between the two statements. And also, Zane is our main presenter, but I will, I'm going to chip in here and there to help make connections between some of his content and the small business work. For those of you who don't know me, I'm Becca Richardson. I am pretty new to LISC. I joined in December, and I am the Senior Program Officer for Economic Development. And I thank Nancy and Tracy very, very much for running this program so beautifully and with lots of help from Barb. So Zane, let me introduce Zane. Zane is a senior accounting manager at CarMax. He is a CPA, and he is a fantastic teacher of some sometimes boring topics, but in the case of Zane, not quite so boring and really helpful for trying to figure out how to make your business better. So I'll kick it to you, Zane.
And before we begin, I just want to make sure everyone realizes that we are recording the session so that you can listen to it back again as a rework, and also so we can send it out to our other folks. All right, thanks.
All right, so yeah, thanks for the introduction, Becca. Yeah, I hope this continues to be somewhat of an exciting thing to learn about. I joked around in the first session and said that this won't be the most exciting thing you ever learn, that's guaranteed, but hopefully not the most boring either. So, once again, accounting for me is a really big passion of mine, just because of the importance it has in business. You hear people say accounting is the language of business. And I really have found that to be true in terms of, if you can understand the financial statements and the entries, it makes your business better. It can make you more profitable because you have that accounting understanding. So what we're going to do today, I'm going to share my screen right now. And we're going to talk about can everyone see? Good.
Yep.
Okay. So today we're going to talk about really the income statement. So revenues and expenses is going to be the topic for today. And really, how do those two categories, those accounts, feed into the income statement? We're going to talk about income statement format, some of the entries and how they tie into the balance sheet. And then we're going to end it with, okay, how can this income statement, aside from it being a financial report, how can it help me, make sure I'm as profitable as I can in my business with different metrics and things that you can analyze. But before we continue there, I want to do just a quick recap. If there was anyone, I definitely see some familiar names today, but if there was anyone that wasn't in the balance sheet class, or maybe just a refresher, within the balance sheet, we talked about the fundamental accounting equation, right? Which is assets equals liabilities plus shareholders' equity. We talked about how you can take that equation and really see it as the foundation of accounting. It's the format of the balance sheet, and you can use that equation to almost read through the transaction, through the entry. Talk about, hey, if you have cash, you have an asset, right? How did you get it? You either have a liability because maybe you took out a loan, maybe you made revenue from a sale, which feeds into retained earnings, which feeds into equity, which is part of that equation. So we talked about how you can read through that fundamental equation in order to make more sense of the balance sheet and of your assets, your liabilities, and equity, which really is just a snapshot in time of the makeup of your business. We talked about the difference between accrual and cash basis accounting. So cash basis, we said that's when you recognize revenue expense when you receive the cash. So not necessarily when you made the sale or when you got a product, but when you actually paid for it or received the money. That's cash basis. For accrual basis, we talked about that's when you recognize revenue and expense when you earn it or incur it. You don't really focus on when you get the money or pay the money out. It's all about when you made that sale or when you bought that good. That's when you recognize your revenue and expense. We also talked about accounts receivable and accounts payable accounts. So those are two fundamental accrual basis accounts on the balance sheet. We talked about the drive-through example, where if you're a customer and you are buying a good at that first window, let's say you're getting your food at the first drive-through window, and that time before you get to the second window to pay for it, you have a liability accounts payable. And if you're that restaurant, you're giving food to someone at the first window. That's when you have your sale and your revenue. And then that time before the second window in that drive-through where you get your money, you have a receivable because someone's going to pay you. So that's just a little helpful way we talked about as a way to visualize those accounts receivable, accounts payable accounts. And then we ended with a snapshot of the balance sheet, which really looks at all your assets, all your liabilities, and all your equity. We talked about equity being what you have invested in your business and what your net income is and what you reinvest into your business as really, once again, a snapshot of your business. So that's a quick refresher. Let's jump right into revenues and expenses. And one other thing I'll add, so I know Becca, mentioned she's going to jump in and to help kind of bridge the gap for some small business practices, which is great. I also really would like for everyone to be interactive. I want this to be conversational. I think one of the great things about doing these sort of classes that I've found is the more people talk and interact, the better the chances are of you learning something from someone else, not just me talking about account. So I'll definitely open up for questions.
If you have additional questions that maybe are not on topic or that you think of as Zane's talking, please feel free to enter them into the chat, and I'm happy to read them to Zane. And so you have both options of interacting or typing into the chat, and we'll make sure we cover your questions.
All right. So I always got to start off with an equation. This is what we did last time. Talk about assets equal liabilities plus equity. So today we're going to talk about the basic income statement equation. And in one quick hit, I think the income statement is the P&L. Some people call it the P&L, profit and loss statement. This is one of those most widely known, right? And if businesses have financial reports, oftentimes the one that they do first is the income statement, because at the end of the day, you're in business to make money. I mean, that's not the only reason, I know, but that's part of it, right? Is you want to make money. And this income statement helps you understand what your profit looks like. What are your revenues and your expenses, and what are you bringing home at the end of the day? So as you think about the income statement, the most fundamental equation that underlies that financial report is revenues minus expenses equals net income. Okay, so this is a pretty fundamental concept. Someone shout out a revenue that you have, and this is not a trick question because there's like one big one that's really a revenue.
Sale of goods.
Exactly, perfect. That's the big one, sales, right? If you sell a good, and it doesn't have to be just a good, it could be a service. Sell of a good or service, that's revenue to your business. That's why you're in business, is to make that revenue from selling that good or service. All right, so now what about expenses? This one can be a lot bigger. Start throwing out some expenses that you may have in your business, or that, some examples you can think of.
Cost of goods sold.
Cost of goods. Yes, sir. What about, and this, hey, there's some that are some overlap between your personal life as well. What's a big expense that you may have just in terms of
Cell phone.
There you go. Cell phone. Yeah, that can certainly be expensive. What about where you live or where your business actually is?
Rent.
Exactly. Rent expense, utilities expense. A lot of those are, they happen in home life too. And they also happen for the business. Utilities expense. All right. Now, what about you getting paid? Are you paying your employees? Right. That's wage or salaries expense. There's some other one. This is a really broad category. You got marketing expense, right? If you're doing certain advertising for your business. But all in all, one of the big categories first, I think Ken said this, was cost of goods sold, right? Cost of goods, that's directly tied to the sale, because if you don't have inventory, you don't have what you need to furnish your service or your products, you're not going to have anything to sell. So cost of goods is a big one. And then from there, there's all those different expenses that go into your business, utilities, rent, marketing, et cetera, that really flow through into that expense category. So if you take those two, revenues minus expenses, you're going to get down to your net income. Now, there's a lot more that can go into that, which we're going to talk about later. There's different steps and different ways you can format your income statement to get down to that final net income number. But at the end of the day, that's really your take home after your revenues and expenses. And then, you can use that to reinvest in your business, goes into equity, et cetera. Any questions on this equation? This one's probably a little bit more standard than the balance sheet equation. But any questions or thoughts on this concept?
Yes, I have one regarding cost of goods sold. Can you tell me how that's calculated?
Yeah, so cost of goods, I mean, some of the most basic ways, right, is what did you pay for the product? Did you have to, after you purchased that product, did you have to do additional things to it to get ready to sell? Did you have, I'm making this up, like if you buy raw materials, right? Let's say you buy wood, and let's say you're a furniture company and you're trying to make furniture. You may buy your raw materials being wood, your screws, your glue, et cetera, but you're gonna have to do additional labor and things to get that material into a quote finished goods inventory. So really cost of goods sold is calculated, how much you paid for the product. Is there anything that you have to do to make it saleable?
Okay, thank you.
Yeah, good question. All right. So next thing I want to talk about is the balance sheet tie-in. So, one thing I really want to do with these two sessions is make sure that I can illustrate how they tie together, because the balance sheet and the income statement go hand in hand, right? Entries that you make, whether it's in QuickBooks or whatever system that you use, oftentimes, which we talked about last time, double entry accounting, you got to have a debit for your credit and vice versa. Oftentimes those two accounts, as part of that transaction, one's on the balance sheet, one's on the income statement. They go hand in hand. So what I want to do now is just kind of talk through an example of buying inventory and making a sale and how those things interact. And I think, Becca, we can go through some examples if anyone wants to talk through something in your business about how this would flow through. But first, let's just go over this very basic example that I have up on the screen. So thinking about those transactions, purchasing inventory and making a sale. The entry for purchasing the inventory is pretty much entirely balance sheet, okay? Because inventory and cash are both balance sheet accounts. And there's really not expense at the time that you purchase your inventory, because you're really just exchanging assets, right? You're exchanging cash for inventory. So as you think about that entry, the debit is to inventory. We talked about last time. Asset accounts are increased with debits. So when you're getting inventory in the door that you buy, you're going to debit the asset account, which is inventory. Now, how do we pay for it? We paid for cash. Talked about last time. Asset accounts, if you're decreasing them, they're decreased with credits. So when you're paying cash out the door to buy that inventory, you need to credit cash. Okay, so this is a very basic example of just purchasing inventory, debiting inventory, crediting cash. And one other thing I would say, because I know last time, and I thought about this over the last couple of weeks, last time a question came up about, how do I know what account to debit and what account to credit? Ken, and I believe you may have asked that question. And
Yes, sir.
We sometimes do something in accounting called a plug, okay? And that really means if you know one side of the entry, you kind of can plug the other side. If you know the accounts, you got to figure out which one to debit, which one to credit. Just figure out one, and you'll be able to figure out the other. Okay, because you always have to have a debit and a credit, they have to equal. So let's say for this example, right, if you knew, hey, I'm getting inventory in the door, I know that inventory is an asset and I've got to debit my inventory account to increase it. If you do that and you know you have cash leaving, you know your credit has to be in cash. That's what we call the plug. Vice versa, let's say maybe you didn't know that the inventory accounts need to be debited, but you paid out cash and you got to do something in inventory, cash has to be credited to be decreased. You go ahead and you credit cash, and your plug is like, okay, well, I know I got to debit inventory because I already have my credit. Does that make sense? So sometimes we'll call it that. If ultimately it's best if you can really think through and get to both sides. But the plug concept can sometimes help when you're trying to think through those debits and credits. Any questions on that first entry when you actually purchase that inventory? Okay. So now, when you make a sale, this is the good stuff. Got your product, you made your sale, you're gonna have money coming in the door. All right, having revenue. So there's really two sides to that equation when you make a sale, and this oftentimes what's missed with this transaction is that second entry, the cost of goods sold. But we're gonna get to that. So the first things first, when you make a sale, let's say someone's gonna pay you cash, $6,000. So when you get cash in the door, that's an asset. We're going to debit cash for $6,000 because you're receiving cash. Let's think back to that concept of the balance sheet equation. Now, how did you get that cash? You had revenue of 6,000. Okay. Revenue accounts are part of, they're credited to be increased. That's part of how revenue is recognized. You can even go back to the plug concept if you needed to figure out what account to credit. But you have cash. Why do you have it? You have revenue, which is an income statement account. Once again, this is showing the tie-in between balance sheet and income statement. Cash is balance sheet, $6,000. How did you get it? You made revenue on your income statement of 6,000. Okay. The second equation, you have to remove that product from your inventory, right? Because you don't have it anymore. And that's where cost of goods sold comes into play. So you want to match the cost of goods sold to when you actually sell the product, right? Because that's when you incur the benefit of being able to sell that product. So cost of goods sold, making those entries, aligns with the actual recognition of revenue. So when you make a sale, you debit cost of goods sold for 5,000 because that was the amount of the inventory, right? This is a basic example, but you paid 5,000 for that inventory. You need to remove it from your inventory at 5,000. So your debit cost of goods sold for 5,000, that's the expense of your product. And then you're going to credit inventory for 5,000 to back it out of your inventory since you sold it. So if you look at this, you kind of look at these entries, you can figure out how they kind of net out against each other, right? So we look at this first one. You debited inventory, you credited cash for 5,000. When you sold it, you did a credit to inventory. Those offset each other. So now your inventory is down to 0 for that sale. And then if you think about, all right, well, what's my net income? What am I bringing in the door? Your revenue is 6,000. Your cost of goods sold is 5,000. So that's going to leave you with $1,000 of net income. If you look at your cash account, you paid 5,000, you got 6,000 in the door. That's 1,000 extra of cash. And look at the end of the day, your $1,000 of cash equals your $1,000 of net income, right? So that's the nice thing about accounting. You always try to get down to make it balance, to make it equal each other.
And this will make additional sense when we look at the actual balance, like when we look at the income statement, and then we can talk about the actual balance sheet too. I thought when Zane and I were talking about this in advance, we thought it would be great if we could get one of you brave people to volunteer to use your business as an example here, so that we could walk through in real life how these concepts actually work.
I will be happy to do that.
Awesome, Charlene. Thank you. I'm going to let you.
One of my biggest challenges, cost of goods sold.
Okay. So Zane, maybe you can help Charlene walk through it. And Charlene, maybe you can explain to us what you sell and what you buy to sell that.
Sure. So I use QuickBooks for my accounting system, and I have a fuel company. So I sell diesel and gasoline. So I don't keep inventory on hand. When a customer orders 7,000 gallons of fuel, I purchase the fuel, and then I invoice my customer, and my customer pays me, and my supplier drafts my account for the fuel that I purchased. So Zane just made it clear to me that the cost that I sell the fuel for and what I pay for it is my net income. So in QuickBooks, I actually have a category for fuel supplier, and it doesn't line up correctly. Like, it doesn't show the fuel supply as a cost of goods. So it picked this random number from a bunch of invoices. So for my QuickBooks system, that cost of goods section is all out of whack. So I would like to just be able to understand that a little better.
Gotcha. Yeah, that's an interesting one, right? Because I hear you about maybe not carrying inventory on hand, right? But there's a period of time when you've purchased that fuel, correct, before you actually furnish that fuel to the customer. Am I understanding that correctly?
No, because it's actually, we load the trucks at the terminal. Like today, if GRTC ordered 7,000, we would go to the terminal, pick up the 7,000 gallons of diesel, take it to GRTC and drop it into their tank. So we don't keep any inventory. Having inventory on a truck means that you can't pick up inventory for the next customer. So you really just buy it and sell it right on the same day.
Right. So, and, in that example, Charlene, I think, and really some of these concepts are conceptual, right?
Right.
Some of these, a lot of businesses, they do have inventory on hand for an extended amount of time. And realistically, if you think about, from me listening to you, you're not going to go into QuickBooks, especially because if these transactions are happening same day, recognize an inventory when you went ahead and sold it immediately after you've loaded up that truck. So I think really it kind of comes down to, netting out your cost of goods sold. And you can kind of look at it as maybe there's a fuel account as an asset, because there is some sort of, and I'm trying to think through this one, there is some sort of asset to you from the time that you have acquired that fuel to the time that you've disposed of it that you provided it to the customer. It may just be the time that it's on your truck, right? From when you picked up that fuel to when you dropped it off at GRTC or whatever the business is. But that fuel between that time is really an asset to you because you purchased it, you've sold it to the customer, but it's still an asset to you while you have that fuel until you deliver. So I think this can also help. The revenue can only be recognized when you've actually completed your obligation to that customer. So when you delivered that fuel, that's when revenue, in most accrual basis organizations, right? That's when revenue can be recognized of when you've actually delivered that product. So in that time period, even if it's really small, and stop me if you disagree with me, please, because I think this is a good conversation. That time period from when you pick up that fuel and when you actually fulfill your obligation and give them that fuel and recognize revenue, that fuel is your asset.
Correct. Right? Correct.
So let's stop talking about inventory for a second, and let's like pretend that's a fuel account. Let's call it just fuel. All right, and this can kind of help us visualize. So you know what I'm going to do? I'm going to go off a little bit here. I'm going to try something because I want to make sure that I want to be able to walk through this together. I'm going off script here, Becca.
This is my favorite time when people go off script. Do it.
I'm going off script. So another thing, I used to teach a lot of these classes in person, and obviously that stopped happening with the onset of the pandemic. So when I teach these classes, I use Microsoft Whiteboard a lot to kind of replace the whiteboard for like in-person whiteboard. So I'm not very good at it. And you can see the last time I did this, look how bad my handwriting is on this whiteboard. So everyone can laugh at me. I know this is recorded, so this is never going away. Everyone for the rest of their life is going to know that I have really bad virtual handwriting. But I kind of want to visualize this together. All right, so another thing, we have these things in accounting called T accounts, which kind of help us visualize the accounts that are on our ledger. So I'm going to kind of walk through this as a T account, but really T accounts are just visual representations of debits and credits. Okay, so Charlene, let's say Monday morning you go and you buy fuel because you got to go and deliver that fuel to a customer. Okay.
Okay.
So I'm gonna call it a fuel account. But that fuel is an asset to you. We can say that's an asset to you, right? Because fuel, that's providing you benefit because you're gonna be able to go and sell it to a customer. So let's just say we can make up a number of how much this is gonna cost. Let's say $5,000 worth of fuel. Just to keep it simple. So that fuel, when you buy it, right, when you pay out that cash for that fuel, that's an asset to you. We increase asset accounts with debits, right? So that fuel, that's an asset. We're going to debit our fuel account for $5,000. And look, I told you my handwriting's bad. So now we've got to have a credit to every debit, right? So thinking back to that example, what is this account going to be? What do we think here?
The receivables.
So this is where we're actually like, we're paying cash for this, right? So we got to pay out to get this fuel. So as we think back to the PowerPoint slide.
Is it either cash or account payable?
Yes, exactly. That's exactly right, Ken. So I'm really glad you said that. It can be cash or accounts payable. So if you're going to pay for it. So Charlene, do you usually pay for it at that time or do you pay for it later when you buy the fuel from the supplier?
I have 10 days to pay for it. So I pay for it within 10 days.
Okay, so you know what? Let's take this a step further. Let's say that you're going to have an accounts payable, okay? For those 10 days. So we're going to call it AP for accounts payable. And that's a liability because you're going to pay that in 10 days. So we're going to credit the accounts payable account for $5,000 for that liability. Okay. So then you have your fuel, you're going to take it on the truck, and then you're going to actually provide it to that customer. And so we got a couple entries to do at that point in time, right? So our first entry is going to be recognizing that revenue. And there's going to be two sides to that entry. So Charlene, do your people that you sell your products to normally pay you in cash, or can they pay you later?
They used to pay me with the ACH.
Okay, so we're going to go ahead and call that cash.
Okay.
And that's good, because I was going to say, if we're doing AP and accounts receivable, this is going to be a fun one. So we're going to go with cash for this sale.
I have some of those too, though. But yeah, for the most part, it's ACH.
Okay. So cash, and that's when you're going to get paid from that customer. I'm going to make up these numbers once again just to kind of keep it consistent. But let's say they pay you $7,000 for that fuel.
Okay.
So we're going to end up having $2,000 worth of profit. So they're going to pay you $7,000. You're going to get that in your bank account, which is cash on your balance sheet. Okay.
Mm-hmm.
So then thinking back to what we just went over, you have your cash. Now, why do you have it? What did you earn as part of this transaction?
Net income.
Revenue. Yep. So we can call
Okay.
it. So you got that cash because you earned revenue from making the sale. That's the sale. That's your revenue. That's the top line of your income statement. So your revenue is going to be, you have to have a credit for every debit. So and the revenue, if you look at these T accounts, you can see what I'm doing. Credits go on the right side, debits go on the left side. I'm sorry if I didn't mention that previously.
No,
Credits on the right, debits on the left.
Just figure that out.
I should have said that earlier. I'm sorry. So that's that. So you got your revenue transaction, you have your fuel, but now because you have got that fuel off of the truck, that's not an asset to you anymore because you have sold that fuel. So we can't keep it on your books in your fuel account anymore because you've made revenue. Because let's say if we keep it in your books as fuel, that's a problem because then we're saying you've made revenue and you still got the fuel. Bad news. So we got to take that out of your fuel account. So this first account, let's say this is fuel. We debited fuel at 5,000. We got to back it out. So we got to, what do we got to do to this account to get rid of the fuel? We debited here. We're getting rid of it. We got to clear it out.
Got to credit it.
Got to credit it. So now the fuel's gone. We don't have the fuel in the truck anymore. There's got to be a debit to every credit. So we got one more here. And so Charlene, this is where cost of goods sold comes in, right here. Because when you made that sale, that's when you're going to recognize the expense of that fuel. That's cost of goods sold. And you're going to recognize the expense for what you purchased it for this 5,000. So cost of goods sold is going to be a debit for 5,000. And Charlene, I'm happy if after this I can always circle up with you individually and kind of talk more about your specific situation too. Because this may be, once again, maybe not exactly how you see it in QuickBooks, but it just kind of goes to, I wanted to show everyone the fuel example because you got your fuel, you have your asset, then you made the sale, you got your revenue, and then you had to back that fuel out of your account.
You lost me on the last illustration. So I'm with you. When you put the fuel as a credit, and the cost of goods sold, in my mind, I see the reverse illustration, like the fuel on the right hand side and the cost of goods sold on the left hand side. But why did you do it in the reverse?
Yeah, so that's a good question. So I think there's a couple ways to think about it. So if we're looking at it from the accounting perspective, cost of goods sold is an expense account. And when we're increasing our expense accounts, we debit those accounts. So when you're recognizing expense, you have to debit that account. That's the accounting example.
Okay.
But if you want to think about it from a different way, when we bought that fuel, that's an asset account to us, and we debited the fuel account to recognize that we got fuel. We debited it. But when we sold that fuel and we don't have that fuel anymore, we have to remove it from our fuel account. So if we debited the fuel to increase it, we have to credit the fuel to decrease that account.
Okay.
That's why that's a credit. Yeah, like I said, we can talk more about it because I know it can get tricky. But and one thing I'll show you. So Kenan, since you brought up the accounts payable, then what you would do, Charlene, if this whole transaction happened, which is like, hey, I've still got to pay for that fuel, right, from the very beginning because you had a liability to set it up, this accounts payable account. Later on down the road, when you actually paid for it, you would just simply, you would have your accounts payable and you would have a cash account, right? And then cash is an asset. When you pay for something, you decrease cash. So you would credit the cash account for the 5,000. And then this accounts payable is a liability. You credited that liability to set it up. We don't need that liability anymore because you paid for it.
Right.
So then you debit accounts payable. And then these offset each other. So that's how that accounts payable would work out.
Okay.
So look,
May I-
yeah, please go ahead.
I'm sorry, may I ask a question about this? Charlene, I appreciate you asking this because this is precisely what we do. We don't really take inventory. We just kind of drop ship, if you will. Two questions. One is your cost of goods sold T account. You have debited. So first of all, cost of goods sold is a liability
It's an expense account.
or expense account. Yep. And so you debited the expense account, right? Which means you decreased it. Could you maybe walk through the logic behind your debiting cost of goods sold again, please?
Yeah, so cost of goods sold is an expense account on the income statement, right? And to increase a balance in an expense account, to recognize expense, we have to debit it. And Kenan, let me try to approach this a different way to see if this helps make more sense. For revenue accounts are increased with credits because they're part of, at the end of the day, they flow into equity. All revenue accounts are increased with credits. And if we think about the fundamental income statement equation, revenues minus expenses are going to equal your net income. If we have revenue accounts with a bunch of credit balances, our expense accounts have to be debit balances to offset that revenue, to lower that revenue to get down to our net income. So expense accounts are increased with debits because we have to decrease, we have to offset our revenue, which are all increased with credits. I'll say expense accounts sometimes are the trickiest accounts to know why, like how to actually move the debits and credits through them. And honestly, one of the most basic ways I can say it is expense accounts are increased with debits and decreased with credits. That's why we debited to that cost of goods sold. And thinking through that plug scenario, we know that we're going to have to remove that fuel for that 5,000. So we have to debit the expense account. So I think, just try to keep in mind expense accounts, when you're recognizing expense and you're increasing the balance in that account, you do that with debits because revenues are increased with credits and they offset each other to get down to net income. Does that help at all?
It does
Yes.
some.
Yes.
Another way to think about it more, as I think you have it on the next slide, is to first picture it on the income statement and then figure out how it affects the balance sheet from there. Because if we remember from the last class, when you do something to the top or the bottom of the balance sheet, you have to do something to the opposite side. So for example, if you have an expense, like if you have a transaction, let's look at this revenue statement real quick. You make a sale, so you're going to have an increase in your sales, and then you're also going to represent whatever you spent for it in cost of goods sold, and then the difference would be there in that net income. And then it's going to affect the balance sheet in different ways. Your cash might go up, and on the flip side, you're going to have a difference in maybe Zane, help me out here. I don't want to say the wrong thing. You're gonna show the net income, for example, the shareholders' equity is going to
Right.
is going to go up as well, so that the numbers balance. Help me explain that piece,
Yeah.
Sam.
Yeah.
Right?
So
I feel like we're getting really into the weeds, and I really want to make this make sense.
yeah. And look, let me just say, first of all, this is complicated. Okay. So like, I don't want anyone thinking, oh, this should make sense automatically. This could be a complicated concept, especially when we start talking about how does the income kind of flow into the balance sheet. But to Becca's point, right? So this is we call it, this is like a single step income statement because it's very basic. We have just revenues, we have expenses, and we have net income. We'll talk about a more multi-step one in a second. But we have our revenues. Now let's think about this in the T account perspective. When you actually show an income statement or any financial report, you normally like don't have like show negatives or like parentheses to show whether it's a credit balance or not. It's just best practice just to show kind of the value of the number. But if we think about how the balance is in the accounts, as I said a second ago, revenues are credited to increase. So let's visualize this as like a credit negative or with a parentheses account, because then we credit a revenue. So this is a credit balance. We have sales of 75,000, miscellaneous income can be from a variety of sources to give us 80,000 of credit balance revenue. Then we have all of our expenses, right? We have cost of goods sold, we have wage expense, rent expense, utilities expense. All these things are expense to the business, all about going to the product that you're selling. All those added up together is 50,500 debit balance. Expense accounts carry a debit balance to increase them. So $80,000 credit balance, and this is what you would see like in your actual chart of accounts or in QuickBooks. 50,500 debit balance for expense. If you kind of net those out together, that's where you get your net income of 22,500, which is a credit balance, right, in this net income, because revenues was a credit, this was a debit. You have more credit revenue for 22,500. This flows into the balance sheet, into shareholders' equity, which is those accounts carry a credit balance as well. So that really gets into the weeds with this. And I think part of the kind of the thing that can make this more difficult is if we think back to that accrual basis versus cash basis accounting concept, right? Because when you're recognizing with just the flow of cash, then we may just be debiting our cost of goods sold when we're actually paying for that good. We're not doing this whole, carrying the inventory, carrying this balance. We may just be recognized like when we're actually paying out the cash, recognizing the sale when we get the money. So I think that could be some of the disconnect, is like how we're actually doing cash basis versus accrual basis. But ultimately, that's kind of how these balances flow together and ultimately offset to get to your net income. They net out against
Good conversation to have, Zane, because to your point, Charlene, and I think Kenan, you mentioned this too, oftentimes we get errors in QuickBooks because we're not, so we show we might show the revenue and we might show the expense, but then if we don't represent the entries that affect the balance sheet correctly in QuickBooks, then you're going to get all those errors. And then when somebody asks you for a balance sheet for your business, you can't produce an accurate one because you haven't entered all the correct entries that affect the balance sheet. So it's a complicated thing. And this is why these conversations are kind of, they're difficult.
Becca, you muted yourself there.
Oops, that was my dog. This is maybe the beginning of several conversations that we have, and maybe some of them offline, but making sure that the simplicity of the income statement sort of gets carried through to some deeper thought in your bookkeeping about making sure that you can reflect what it looks like on the balance sheet.
And for me, this is by far the simplest income statement I've ever seen. I mean, it just brings it all, makes it a clearer picture, just seeing the cost of goods listed under expenses, because on QuickBooks, on the profit and loss, is listed under income, and it's very confusing. So this really probably is the clearest picture I've ever seen of an income statement.
Good. Yeah, Charlene. Yeah, this one I'm gonna make a little bit more in this next slide, but I think it'll still be helpful. And once again, this is the same thing when I do these classes. The goal with this of doing these things is not to have everyone walk away and say, I got it all down. I know all this accounting stuff like the back of my hand, because it's just not feasible. Some of the things that we're going over in these sessions and what we went over in the first session, those concepts are like introduced sometimes over an entire class in accounting. What the goal of this is like, I'm just trying to give some tools and give some concepts that hopefully you can kind of like take back and think through and start applying to your business. And then hopefully at some point things will start clicking, because at the end of the day, fundamentally, it all comes down to these accounts and how they interact with each other. So, I always like to say that too, because this stuff it's not something that can be picked up instantaneously. It kind of takes forced application of thinking through how it applies to me. But these are great questions, Charlene. I've really appreciated that, and Ken, you as well, to kind of help us think through this. Any questions on this though, on this kind of simple single step income statement?
Yeah, I have one question. What is considered to be a healthy net income? Because obviously the higher the net income, I'm an LLC, so whatever gets left on net income goes on my personal tax return. So what's considered a healthy net income?
Yeah, so that's a big question, Charlie. I think ultimately, you know what, can we save that? Because I want to talk about that in our last slide.
Yeah, sure.
We'll save that one because I think that'll fit in best in my last slide.
Okay, sure.
All right, so I've only got two more. So that was single step income statement. Now let's look at multi-step income statement. And this kind of reflects, what I think to be a little bit more hardier income statement, because it really kind of helps you break down those accounts and how they interact with each other even further. So walking through this one, these are the same numbers, I hope. I checked it a few times. I hope it's the same. But we lay it out in a different way. So we still have our revenues, our $75,000 of sales, our miscellaneous income of $5,000 for total revenues of $80,000. But then we bring in cost of sales. Ken, I believe I heard you say this earlier, which is really also known as cost of goods sold. That is $45,000 to give us a gross profit of $35,000. And so this is where the whole multi-step income statement comes into play. There's some things called operating expenses and non-operating expenses. But what I really want to show here is, gross profit is all about the sale of the product, all about the product itself. The stuff down below it we'll get to in a second. That's not directly tied to the product. Your sale, that's selling your product. Your cost of goods sold is what you purchased it for. Did you have to do any work to make it saleable? That's your cost of sales. Those two things together are going to get you to your gross profit, right? Your net income is down there at the bottom, but your gross profit really helps you understand, what is my profit simply based on the sale and purchase of the product. This is a really important metric, which we'll get to in this last slide, of how you can track and analyze your income statement, is looking at this gross profit. Revenues and cost of sales get you to your gross profit, all about the product itself. Then we have this second section down at the bottom. A lot of people call it selling, general, and administrative expenses, otherwise known as SG&A. I don't know if anyone's heard that term before. Those are all those expense categories that aren't directly tied to the product itself. Wage expense, rent expense, utilities expense, they're still expenses to your business, but they're not directly tied to the sale of the product. So we categorize them as SG&A, selling, general, and administrative expenses, on the income statement. Those equal the $12,500. Your $35,000 of gross profit minus your total SG&A of $12,500 gets you to your net income of $22,500. Now, if you look back, that's the same net income as this single step income statement, but this section, the expenses section, is not broken down into cost of sales and SG&A. On this one, it is. And we'll get to in this last slide why this is important, but ultimately it comes down to, this makes it easier for you to understand your profitability and where you can leverage different things within your business, potentially to either improve that gross profit number or that net income number. And look, there's normal income statements, there's more accounts, you got things like taxes that you got to pay, that you got to show that's expense for. Like there's definitely more accounts, but I really want to keep it sort of simple for this demonstration. But just when you're thinking about kind of multi-step or a more complex income statement, it really separates gross profit, your other expenses, and then your net income. Let me stop there. Any questions on either of those or seeing this? Out of curiosity, for those of you that produce an income statement, what does yours look like? Does yours look more like this? Or does it look more like the first one, or not like either of these? Charlene, maybe yours, maybe not like either of these.
I'm looking at mine now. Actually, I don't think it looks like either.
Yeah. So, that's.
I mean, the top portion does, the revenues, manner of cost of good, and the gross profit, but you've actually made it very plain, because like I said, it doesn't show how the expense ties in. I know that the expense gets deducted, but with your illustration, it just makes it clear to me. And I would love to know how to leverage, like you said, the gross profit during the course of the, from quarter to quarter, to be able to make sure that I increase my net income, by the end of the year.
Right. Yeah. Great.
Hey, Zane, I just want to mention something. Just, Charlene, I feel your pain. I feel everybody's pain when I ran my own business. And this is why this is so important to understand this. And Zane, again, this is awesome. And then what you will do, hopefully, is you'll just start month over month. So you really can start comparing what's going on in your business. And then all of a sudden, if you see an uptick in wage or utilities, all of a sudden you're like, whoa, wait a minute, why is my electric that much higher? And it just gives you the capability of really understanding the cash flow. And then month over month, you can really analyze your business. Is that valid, Zane? I mean,
absolutely. No, that's actually a great segue into my last slide here. Income statement is over time. So we talked about balance sheet. That's a snapshot in time. That's what you have in your business. But income statement is, how did you perform your revenues? How much were your expenses over a month, or over 3 months, or over 6 months, to Nancy's point. And yeah, the great thing about the income statement is a fantastic tool for understanding your performance, your financial performance, and where you can maybe leverage things. So this is kind of the last slide, is using the income statement. Obviously, a big use of it is maybe providing for a tax accountant for taxes, for applying for grants, things like that, having this financial statement. But another huge use is, once again, tracking profitability, analyzing your business. In this first sentence here, analyze revenue expenses compared to budget. I bolded budget because, I don't know. It's sometimes not a widespread practice to budget these accounts, but what can be a good practice is, hey, this is what I'm going to budget, what I want my revenues to be, my sales to be. I'm going to budget. This is what I want my wage expense and my utilities expense. This is my budget. All right. And then once your actual results come in and you produce this income statement, it kind of gets to Nancy's point. You can look at what your actual balances were in wages and utilities and sales, compare them to what you had budgeted, and look at the variance. Did you perform better? Did something go up unexpectedly that you're like, this doesn't seem right, that you need to investigate further? Is there areas where you're like, hey, maybe I want to make more profit or more income. Maybe I need to look at raising prices, or should I try to renegotiate fees with my suppliers? Just a bunch of random things there. But income statement, and especially if you introduce some sort of budgeting into what you want your income statement to look like, it can really help you track and understand how those accounts are performing financially. And that kind of gets to my last point, tracking performance and profitability. And going back to this kind of multi-step income statement, you can look at profitability really a couple of ways. Your gross profit, once again, all about that good or service, your revenue and your cost of sales. And then all the way down to net income, once you count in everything, all your sales and all your expenses, where do you want your net income to be? So Charlene, going back to your question about what's a good profitability number, I think there's a million different ways to answer that question. I think it is, certainly business based, depending on what your goals are. You have some people out there say, hey, the more money I got, the better. Some people may approach it of, I want to sort of leverage my profit to figure out what my tax obligations are going to be, right? Like there's so many different ways you can approach that. And I think the best thing that I can say is look at your income statement, come up with a budget. There's all types of different formulas and ratios that are widely available online. You can just search like financial statement ratios that can help you look at different balances in your accounts and look at what those ratios are, and are they at a solid number? So Charlene, I would say if you have some time, just go and look up financial ratios, and then you can kind of play around with your balances to see where they calculate out to be.
Okay.
So yeah, but budget, tracking profitability, the income statement is a fantastic tool. It really is to monitor performance and track profitability and ultimately help make decisions for your business. So that is all that I had today. I know we only got about 5 minutes left. I think we had some great conversation. I hope everyone didn't mind all my terrible handwriting on that whiteboard. But I think it was good for me to get on the spot and try to work that out. Any questions at all from this material, things you thought of since the balance sheet that I can help answer?
So I've actually got a broader question. Is this it? Is this the end? In other words, are there other, perhaps hour-long or what have you training sessions that you're conducting?
I think this was going to be the last one for me. Yeah, I think this was going to be just the 2-part series.
Gotcha.
This is the end based on this webinar series that we've designed, Kenan. But I'm curious, are you finding these helpful for you?
So me personally, yeah, I kind of think about this as, how do you wear down a rock, right, with water?
Yeah.
It's a drip sort of thing. And I think the more that I hear these kinds of concepts explained and illustrated in a simple way, such as, how Zane has done it, I think that I get closer to, better understanding. So,
this is really good feedback. This is good
Yeah.
feedback because, we offer all types of webinars, as you know, and I think that the financial part of running a business is one of the few things about running a business that is really sort of it's a theme for every single business. Every business has to put together financials and has to understand their financials to thrive. So clearly this is a really important topic, and I think that internally we should think about more of these, and we will communicate whenever we do have more of these available. And don't worry, I will be recruiting Zane to hopefully do some more of these in the future.
That's great. Yeah, just a tad bit more feedback. So we, like I'm sure all the other organizations attending, are members of groups in the Richmond area and elsewhere. And we've asked for precisely this sort of thing, right? This is a gotta have, gotta understand, how does it work with QuickBooks? All the great questions that Charlene has asked and brought up. But, thus far, no one's really kind of come through with this kind of training. So I think that this is terrific.
Thank you so much for sharing that. That's incredible feedback, and I think that we're going to need to offer more in the future.
Kenan, may I ask what your business is?
We sell medical devices and instruments and capital equipment, primarily to the government, the VA.
Gotcha. Okay. Yeah, I will echo Becca. This is exactly why we're doing this. And we have one of our seed coaches with us, Barb Upchurch, and we know in Tracy, and we just know that this is an ongoing need. So that is really good feedback. Thank you.
And Zane, I just would like to say, I don't think you could have done anything to make this clearer. I mean, you did an excellent job with the presentation. If I was ever seeking to take a class, I definitely want to be one of your students.
Thank you, Charlene. Yeah,